So Netflix has been one of the big investing stories over the past 5 years. And with rapid expansion throughout the world and a dominating market position, it has justified all of the hype. They have delivered entertainment to millions of people, and Netflix and chill is part of our vocabulary now. But from an investor's point of view, what does the future for this entertainment powerhouse look like? Hi, if you're new, welcome to my channel, and my videos are all about investments that anyone in the world can make. And for those of you who are regular watchers, well, you may have noticed my new location. Well, the reason is I've just made the very interesting journey from the mountains of Georgia to Kiev in Ukraine. I had to drive, I had to catch a train, I'd spent a couple of days on a ferry, and I caught a flight, but I made it. And Kiev is just one of my favorite cities in the world, and I'm just so happy to finally be here. Okay, that's enough about me. Let's get back into Netflix. So today I'm going to approach this analysis from two different angles, the glass half full approach and the glass half empty approach. And of course, I'm going to go through the financials of the company to judge them from that angle as well. Now, I'm going to do this entire video from my perspective, and yes, at times it's going to be quite anecdotal, but I think that's actually part of analyzing any company. You have to take it from your perspective. So it's most likely that you're going to have a different perspective on some of the things that I say. And that's a good thing because that's how we create value in the marketplace. Just imagine for a moment if we all thought the same, well, that would be awful because none of us would ever get a good deal. So I'm going to start on the positive side with the glass half full approach. Okay, so it's quite obvious that for the last, say, 15 or 20 years that the internet has really changed the media industry. And I would have to say that it started seriously with Napster back when I was a child. Then even after the Napster days, we were still downloading movies, TV shows, and music, but just from dodgy websites with lots of viruses and pop-ups. And as time went on, internet speeds improved, and then streaming was a viable option. And Netflix, I think, definitely had the right approach. See, where other media companies were scheduling what you watch and at what time, Netflix created the ability to watch a TV show at whatever time of day suited you. And again, different from normal TV, they weren't going to pepper you with all of these ads. You just have to pay a subscription to their services, and that's how they generated their revenue. The other secret sauce they had was the global reach they could gain by using the internet. So previously, TV shows were region specific and broadcast from regional centers through wires and cables. But Netflix, well, they could reach scale by leveraging the internet as their connection point. Now, it wasn't simple at all. They had to invest huge amounts of money in new content that would keep their audiences entertained. And by spreading throughout the world, well, they had to realize that different countries wanted different content and they had different viewing habits as well. So the way forward was to invest big time into content, and that's exactly what they did. Now, as unlikely as it was for the company to reach the scale that they are now, well, growth has been very impressive, reaching all corners of the globe and still growing. And for those old school, like traditional media companies, well, now it's so difficult to compete against Netflix. It's because Netflix are now big enough that they can pay the most for the content, and because they have so many users that their cost per user is now also the lowest. And this is the big thing here. I think their competitive advantage against traditional media is just really strong. And growth rates are fantastic, soon to be at 200 million paying subscribers. So they have reached scale, and now they can mature and turn into a profit-making machine. Okay, so we've looked at the half glass full approach. Now let's take a look at the half glass empty approach. Well, Netflix have done a lot of things right, and their competitive advantage over traditional media, I think, is really strong. But the competition that is coming for them are from outside traditional media, and this is fierce. See, Netflix makes their revenue from paying subscribers, but the competition makes their money from other areas and can outspend them now for longer. For example, Amazon makes its money from Amazon.com, and the hundreds of billions of dollars that they make can be invested into taking market share. Disney, making their money from theme parks, Marvel movies, and merchandise, can pile their cash into Disney Plus and take another piece of the market. And then we have Apple, making hundreds of billions of dollars selling iPhones and AirPods. They can also outspend Netflix now. Well, if that wasn't bad enough, well, that's just the US market. Netflix also have to battle the deep pockets of Tencent and Alibaba and a range of other competitors all wanting a piece of the streaming market. So although Netflix lead the way and is on top for now, I would have to say the future is definitely unclear. If your competition were Apple, Amazon, Disney, Tencent, and Alibaba, well, I would be worried. So if you were in Netflix's shoes and you had to compete against these big giants, well, how would you do that? Well, I think you would have to just make sure you have the best content. So Netflix have been doing an amazing job with their original content, but can they continue to execute on this original content? So the big question is, will they be good enough to fend off the competition? And honestly, you're braver than me if you can see what's going to happen in the future of online streaming. I have no idea what's going to happen. Now, for those of you who are the glass half full approach, well, let's go and see the financials and see how they stack up. Now, we need to expect that they've been spending huge amounts of money on just their original content and expanding throughout the world to get to the scale that they have. So even before we begin, I'm going to assume that the financials are going to reveal that this company is going to be clearly a growth company because they're trying to get as big and as dominant as they can as quickly as they can. So just remember that as we take a look into what is going on financially. Now, of course, there are three key areas to the health of any business. We want to see whether they can handle their debt, are they growing, and are they a well-managed company? And please just sit back and don't worry about the terminology, just get a feel for what's going on. So first up, can they handle their debt? And we want to make sure that they can handle their debt because if the business was to completely stop for some unforeseen reason, I don't know, some crazy government decision or something, well, we want to make sure that they can get through this tough period. So to see if the business can handle its debt, I went through the debt to equity ratio and the current ratio of the business. And for Netflix, well, the debt to equity is better than I first expected, but it is still too high. Under 0.7 is a good number, but Netflix is currently at about 2. For the current ratio, I'm looking for above a 1.5. And Netflix, well, it has previously been good except for 2019. So I wanted to see this above a 1.5, but is actually a below a 1, which means there's every chance that they will issue more shares, borrow some money, or maybe sell some assets. All of this is not good for shareholders. But revenue for 2020, well, hopefully it's going to be strong, so they might be able to handle the debt. I think it's going to be a close call, but I don't really like close calls. Are they growing? And if we're going to consider them a growth company, we want to see them pass this with flying colors. This really does have to be their strength, and we have already seen their subscribers growth graph from earlier. In the finances, to check for growth, I look at the book value per share, the earnings per share, and the operating cash. And in these graphs, well, this is the growth we wanted to see. Earnings and book value. So it's all really good stuff here. Now this is the operating cash graph. Well, they are spending up a storm here. And I guess this is to be expected of a growth company, but essentially they are spending more money than they are making. If you have watched my previous videos on Facebook or Skyworks, Amazon or Google, well, you would see what good financials look like for a tech company. Okay, now I know it's a little bit unfair to compare Netflix to those companies at the stage that they're currently in. And look, I get it, Netflix have to be aggressive to get as much market share as they can, to be as dominant as they can. I get it. Now let's see if the company is well managed. And we can't obviously just sit in with the management team and see what they're talking about in their meetings. But there are some telltale signs in the financials that tell us whether management are making some good decisions. So I'm going to check the return on equity, free cash flow, and their cash on hand. This is return on equity, and it has been increasing for the past 7 years. So I'm very happy with that. Anything over 15 is a good number here. Okay, so another sign of the company investing big time into content and the future. Look, I totally understand this, and it makes sense to stay in front of the pack. But when are they going to mature and be the profit-making machine we want to see? So there's really nothing wrong here with the management, but I just don't like to see negative free cash flow for any business that I invest in. So the whole theme of this video is that I appreciate that there are two schools of thoughts on investing into a growth company. So for Netflix, well, the glass half full approach looks like this. They have a strong competitive advantage because they have reached scale. They have far longer experience than their rivals in content creation. And they are expected to grow at about 30% a year for the next 5 years, well, according to the analysts. And of course, then there is the half glass empty approach to Netflix. The competition that are aggressively moving into their market are Amazon, Apple, Disney, Tencent, Alibaba. This should be enough to keep the management up at night. They don't have the deep pockets that these more established companies have. They also don't have the multiple streams of revenue unlike these rivals as well. The finances indicate a typical growth company, but the competitors are more mature and don't have to go into debt to fund the expansion into streaming and new content. Well, analysts don't know what they're talking about. They can't predict the future. They get paid just to guess. All right, now let's take a look at the share price for all of those half glass full people out there. And currently the share price is $540 per share. And that'll give the company a market capitalization of $240 billion. Now, considering they are making about $4 per share in earnings, well, the price to earnings ratio is 111. So if nothing was to change, it would take 111 years to get your money back from this investment. Does that sound like a good deal to you? Now, of course, so many people have been forced to stay at home recently, and entertainment has been very important. So Netflix is going to be one of the few companies that in 2020 is going to get a big surge in new paying customers. So let me put it another way. By looking at the growth rate of the company, if it was to continue growing at what the analysts expect at 30% per year, well, compounding this 30% year on year, well, they would be making, say, $75 billion in revenue in 5 years' time. Now, that's nearly 4 times as big as they are now. So let's assume that this will happen. Therefore, earnings per share will then be about $18 per share, which means that if the market cap stayed the same, it would give you a PE ratio of around about 12.5. So in my opinion, the company is valued at about what it could be worth in 5 years' time. And look, to me, that just doesn't feel like a very good investment because they would have to keep up that very high growth rate of 30% a year for 5 years. So they can't have any hiccups and they can't have any interference from the competition, and they have to do it for 5 years in a row. So in my opinion, do I think Netflix is a good company to invest in? Now, today I wasn't able to use my intrinsic value calculator because Netflix have negative free cash flow. So what I had to do was I had to take more of a estimated future price to earnings ratio based on the growth rates, and it was a little bit of guesswork, and I don't really like to do that guesswork. I much prefer the stronger mathematical principles based in the intrinsic value calculator. Okay, so now here is the summary. Netflix is a fast-growing company that will benefit from the crazy year we are having. Their competitive advantage is strong because they have reached scale. But the new competitors are non-traditional media companies like Amazon, Apple, Disney, Tencent, and Alibaba. Growth companies are also hard to accurately value. Look, I'm not going to be an investor anytime soon. I really like to use Monish Pabrai's saying for an investment where he says, heads I win, tails I don't lose much. Well, in this case, and for a lot of high growth companies, well, I don't know what that upside is going to be. Maybe they've already reached this upside. So this is not the investment that I want to make, and I'll have to keep looking for better opportunities out there. Make sure you hit subscribe if you like that analysis, and I will see you in the next video.